I'm John Hanna for CDTV.net in New York, and we have Dirk Dijk joining us from Dayton, Ohio. He's the Chief Equity Strategist at Zacks.com. Thanks for joining us, Dirk.
Always a pleasure.
Now, Dirk, it's the unofficial start of the summer, Memorial Day weekend, but the sun is shining here in New York. How about there in Dayton?
No, it's sunny. It's hot and humid. It feels like summer. Unlike a couple of weeks ago when I thought it was still February.
Right.
But it's definitely changed. We've had some pretty intense thunderstorms out here too lately. Hail that looks like it was coming out of ice cube trays.
Wow.
Kind of stuff as well.
It's kind of like that season where people are trying to sell in May. What was that saying again in Wall Street?
Well, it's sell in May and go away, but remember to return in November. And that's just, there's a historical pattern that is, tends to work pretty well. And over since World War II, the average return between, May and November or May and October is about 1/3 the return that you get in the other half of the year. Something, this is off the top of my head, but something to the order of, 1.5% on average annualized versus 5.7% annualized if you buy in May, they buy in, say, the day after the day after Halloween and hold it till, till Derby Day or something. You get about 3 times the return. So, there's a definite seasonal pattern to stock market returns. There have been all sorts of, academic studies into it. Some of it has to do with timing of tax sales and stuff like that, and also people tending to put money into the market, in January and then in April to sort of beat the IRA deadlines and 401k sort of deadlines. So those are some of the plausible reasons for this, but there's a very distinct seasonal pattern. There's also a very distinct pattern by years in the presidential cycle, and we happen to be in the best year of the 4. You want to be in the 3rd year of the presidential cycle, has on average, and there's a lot of variation around these averages, obviously, but on average you get about 3 times the return in the 3rd year of the presidential cycle as you get in the other 3 years of the presidential cycle. So that's a positive right now, being somewhat offset by the normal seasonal weakness. That doesn't mean, that things are going to absolutely fall apart in the summer, but, you get into sort of the summer doldrums type thing, and September and October are notorious dicey months. Saw that most dramatically back in 2008, but we've also had historically, the '87 crash was in October, the 1929 crash was in October, so those are the sort of rougher months historically.
Wow, this is one of the reasons that we love having you on CDTV.net, as you have a lot of facts and information out there.
Well, you spend a lifetime looking at this stuff. Some of it sticks in your mind.
There you go. Okay, so what do we have for the present? You mentioned earlier that the Case-Shiller index.
Yes, and the Case-Shiller is the sort of the gold standard for housing price data. It's actually a repeat sales index, so it's measuring the same houses as they've been sold, so it's not affected by the mix of houses like the median numbers can sometimes be. The problem with it is it's pretty old data. This is the data that came out this morning is actually for March, and that's actually a 3-month moving average. So we still have data in these numbers that's coming from January and February as well as March. But it is a very carefully constructed index, and it covers 20 of the largest metropolitan areas in the country. It originally started with 10 largest areas, so you've got 2 indexes, the C10 and the C20. The C10 has a longer history, but the C20 includes the C10, the composite 10. The C20 was down 0.23% in the month of March relative to April, and relative to March of a year ago, it was down 3.53%. The declines were pretty widespread. You had 7 metropolitan areas that were up in March and 13 that were down relative to February. The increases were much smaller than the declines on the individual cities as well. And when you look at the year-over-year numbers, there was only one city that has higher housing prices than a year ago, and that's Washington, D.C. 19 others were down. Washington, D.C. really is a standout, with prices up 4.38%. Let me remind people that I'm using the seasonally adjusted numbers here. While most of the press uses the not seasonally adjusted numbers, I think most of the press is making a mistake in that regard, because there is indeed a historical seasonal pattern to housing prices. But the next best year-over-year city is actually Detroit, believe it or not. But prices there were down 0.79%. Now, Detroit is, it's been down so far that anything looks like up. It never enjoyed a bubble, and so that's probably, houses moving from 10,000 to 10,300 or something like that. But the other relatively strong cities were, on a year-over-year basis, were L.A. down 1.65%, Boston down 2.57%, and Dallas down 2.45%. On the other end of the spectrum, the Twin Cities are just been hammered, down 9.83% over the last year. Phoenix has been a long-term poster child for the housing bust. It's still down 8.4% from a year ago. Now, relative to the national peak in April of 06, we're talking about Phoenix being down 55.11%. The only city that has been hurt more is Las Vegas, down 58.29%. And we have a third member of the half-off club, Miami, down 50.01%, so just into the off 50% club. In terms of the markets that have held up best from the peak, Dallas is by far the standout, down only 5.87%, and then no other city has managed to avoid a double-digit decline. The next best is Denver, down 10.61% from the national peak. Now, I wish that I could say that, boy, the damage is all done, and and now is the time to rush out and buy a house. Fortunately, I don't think that's the case. In April, the amount of inventory that was on the market amounted to 9.2 months at the April selling rate for existing houses. And looking at the pending sales data, it looks like May and June are going to be off sharply. So we've had a bust in terms of a spring selling season, and you still have the inventory overhang from all these foreclosures, and as house prices sink, it sort of gets into this nasty cycle, because as you should have no foreclosures if the value of the house is greater than the amount of the mortgage, right? It's regardless of how bad your cash flow is. You get horribly sick, you get divorced, you get laid off. Name your nasty cash flow situation. If the house is worth $150 and the mortgage is worth $140, even if you can't pay the mortgage, it's going to make sense to sell the house and get something out of it, rather than the bank just taking it and be out on the street and have nothing to show for it. But as house prices sink, the mortgage value stays fixed, and you get more and more under-order houses. That makes more and more foreclosures possible, which again adds to the supply of houses for sale, forcing down prices even more. Now, fortunately, even though these dynamics are very much in play, house prices are not as insane as they were 5 years ago. And what's the definition of insane? Well, look at your house as if it's a capital asset, right? And everybody thinks of their house as an asset. But, an asset price, is usually determined by the amount of cash flow that it's going to generate over time. What's the cash flow of the house that you have? Well, it's the fact that if you own a house, you don't have to pay rent. And so the relationship between how much it costs to buy a house and what it costs to rent an equivalent house is obviously very significant. And that was the real clue that we were in a housing bubble, is that relation just got totally out of whack. We are back down close to the historical norms. We're not below the historical norms on a price to rent basis, but we're within what would say the normal range of the relationship of house prices to rents. And rents have been starting to climb. We've had much more absorption of vacancy in rental properties than we have of getting rid of the inventory overhang of existing houses for sale. So that's we're starting to see some increases in rents, not runaway, still below overall inflation, but it's starting to pick up. So that relationship will close a bit on that side as well. And, but you're getting to the point where in a lot of areas of the country, it just makes financial sense to buy the house, even if you're not counting on, long-term capital appreciation for the house. So I think housing prices are still going to decline. That decline probably should be over by the end of this year, and maybe we'll be down another 4 or 5% from current levels. That still can do a fair amount of damage, given the dynamics I was talking about earlier, but we're not looking at another 30% collapse like we have off the peaks. So, I still wouldn't be investing in any of the home builders or the companies that do a lot of supplying of building products. That just doesn't seem to be the place where things are going to be happening. Eventually, though, we are sort of setting ourselves up for a heck of a boom. I mean, new home sales running at 300,000 level. That is just plain awful. I mean, that's less than we were selling back in the early 60s. And, the population's a lot bigger, and we've been having this really low number of housing starts for a couple of years now. And, population's growing. Their houses do deteriorate and get torn down and demolished. And so there is going to be a need for more housing. And from these levels, you can easily generate some very, very impressive percentage gains. So there is going to become a time for those. And when that construction gets underway, that is going to put a huge boost to the overall economy. After all, construction is responsible for 1 out of 4 jobs lost in this recession. And that's just the straight construction jobs. That doesn't count the manufacturing jobs in the factories that are producing building supplies. It doesn't count the lumberjacks. It doesn't count the people working in the mortgage industry or any of that. And, so 1/4 of all jobs just from the construction sector. When that gets going, that should do an awful lot to help the overall employment situation, but it just doesn't look like it's going to happen yet. But, it's not crazy to think that 5 years from now that new home sales could be, easily double, if not triple, current levels. That would still put us at a relatively anemic rate of new home construction and sales relative to the historical norms. But in this business, there's not that much difference between being wrong and being early. And I think that investing in those sorts of stocks, you're early, and probably at least a year early. But there will come a time when they should be very effective.
That's Dirk Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. And I'm John Hanna for CDTV.net in New York.